then Emma looks like she's ready and waiting for us in the wings. So Emma is from Church House Investments, and you are a specialist in superyacht crew, financing, planning, every aspect of that. And we were lucky to have Emma and Anna and Titta and I on a radio interview on Superyacht Radio a few weeks ago. So we were able to glean a little bit of Emma's knowledge now, but we're going to be learning some more about what you can do for crew, how you can support them. You know, sometimes it's just having the confidence, and certainly for me, having the knowledge that my finances are in order gives me great confidence to be able to go forwards and do things. Certainly that was probably one of my biggest worries when I was starting my own business, from going from employment to being a business owner, was the financial side of things. And, you know, am I ready to take that jump, and have I got everything lined up? And Emma made a good point before that sometimes you just need somebody to you know, confirm that what you think is correct, and then also have somebody give you really great advice, because the finance world is a huge subject, and, you know, experts know things that we wouldn't have even thought to begin to try and investigate. So I think that the finance side of things is a really important part of the support that we are offering. So Emma, are you pretty ready to come in and have a chat with us?
Hi, yes, Sarah, can you hear me?
I can. You are loud and clear. We are, we're having a great day. We're all live and everything's working to plan, and you arrived on time. So far, the day is going very smoothly and swimmingly, and we're really pleased.
Brilliant.
Here.
So from New Zealand to London in one swoop.
We and this is the power of the digital age, isn't it? We also just, you know, mentioned earlier we had to adapt. We were going to all be in Monaco Yacht Club today, and now we're all in our separate locations. But actually, it's, if anything, it's widened the ability for people to be able to join and hear our advice. So sometimes, you know, the overcoming challenges can create new opportunities, as they say. So
absolutely, yes. Absolutely, the glass is always half full.
Yes, yeah. And my glass is definitely always half full, because I enjoy it.
Thanks to that straw.
Yes, exactly. So without further ado, then I'm going to hand over to you, and we'll switch off our video so people can focus on you, but we are here in the background. So if you need us to jump in at any point, or you're ready to finish, don't panic that we're not here. We're all here in the background. So please do tell us all about yourself and what you do and how you can support crew.
Super. Well, thank you so much, Sarah. And thanks, Titta. I haven't said hello to you yet, but I know you're in the background somewhere. And also lovely to see you, Anna. And what a great and inspirational speech. I caught the last half of it there. And as ever, terribly inspiring and such wise words. So it's a pleasure to follow on from you. So just a bit about me, as Sarah mentioned, my name is Emma Parks, and I'm an investment manager and financial advisor at Church House Investment Management, where I've worked for the last 5.5 years, based in London. Prior to that, I worked at Barclays Private Bank and also worked in the hedge fund space. So I've got quite a long track record. I started our yacht crew investment proposition earlier this year. And that came from a place of having lots of friends and family who had gone through the transition from on sea to on land, and found it quite difficult and anxious making and stressful. And they also were telling me time and time again that there was quite a lack of trustworthy financial advice. So that's what spurred me on to start up this proposition. And I've been learning a lot, you know, from people on the ground as to what everyone's needs are and what people's worries are, and where I can hopefully add value. So this is where we've come to today, and I'm delighted that Titta and Sarah have asked me onto the panel today. And also congratulations to you and the team for creating this event in such a difficult time. I really do admire it, and it's wonderful to be part of such a strong and interesting panel. So I can't wait to see how the day pans out. So without further ado, my plan is to run through 4 key points that basically, I think we'll help you to get your finances order and hopefully clarify just 4 important things that you should focus on finance-wise. I am going to attempt to share my screen with those of you on Zoom, so that, now let's just try and do that now, so that for those of you who are on Zoom can see. Right, here we are. Now, hopefully those of you who are on Zoom can see that now. So I've got some supporting slides, but if you're not on Zoom, if you're listening on Super Yacht Radio, hello to you all. Great to have you with us. But I think Sarah and Titta will be uploading these slides to the Life After Yachting portal. So please do go and visit that at your leisure if you want to look back over it, if you're thinking over things once I finish this talk. But right, so to kick off, and as per the first slide that those of you can see, these are the 4 points that we're going to cover. So what can I do now? Point 1, try and plan your exit as soon as you can. And the main thing about that is to make sure you have an emergency cash fund in case you find yourself between boats or leaving unexpectedly. Point 2, we will cover tax efficiency. So that is to make sure you're saving as tax efficiently as possible whilst working at sea, so that you minimize any tax you might need to pay once you return to land. And that is not just relying on your seafarer's earnings deduction, by the way, so we'll look into that a bit more. Point 3, pension. Now, I know it's not the most riveting subject, but it is something everybody really needs to start thinking about as soon as possible, and I'll explain why. And the final point 4 is to make the most of your savings. Now, in order to make the most of your savings, you need to be aware of the risks of holding cash, namely inflation and low interest rates, which are eating into the real value of your savings pot. So I will go on to explain all this in more detail, along with opportunities for investment. So now let's go through these points in a bit more detail. So how to plan an exit. And obviously I do realize that it isn't always, a planned exit. Sometimes you're leaving without a plan, but that is sort of my point, is that if you can always have a backup plan, then so much the better. So a contingency plan is really important. You need to know what savings you have available to look after you should you not be able to work. And I would suggest building up a cash buffer of 4 to 5 months living expenses in case of an unplanned exit. And you should really start building that up from the very beginning of your career, as I say, just in case. If you're making a plan for a scheduled exit, there are various factors that you should consider, and possibly things that you might not have had to worry about previously. And these may vary depending on your reason for leaving. Are you just looking for a land-based job? Are you setting up a business, which I know lots of you are who are here today? Or are you retiring? If you're leaving to find a new job, you'll need a realistic estimate of how much you hope to earn net of tax. Net, by the way, means after you've paid tax. Think of it like a fishing net, so what you're actually catching. I know sometimes net and gross is a bit confusing, but net is what you actually get after tax, what you catch in your fishing net. You then need to factor in rent or mortgage payments, and of course all those little extras that you might not have had to pay for before, like deodorant and shower gel, you all know. This all mounts up and will really impact what you're left with at the end of a month working on land. You should also find out if your new employer will offer you things like private healthcare, what pension benefits they will offer you. Are you on a contract? Are you a full-time employee, or are you self-employed? And this will really impact things like pay, like holiday pay or sick leave. Perhaps you're leaving to set up your own business, and in this case, it's really important that you keep that emergency cash buffer separate from cash that you're thinking of investing in your new business. It's all too easy to misjudge how to plan an investment into a business and then leave yourself with nothing at all to live on. So you must be really strict on that. And lastly, if you're leaving the industry to retire and you've built up what you think is quite a nice savings pot over your career, it's really important to have a clear idea of what you will need to live off to maintain the lifestyle that you want and have been looking forward to and working really hard towards achieving. Now, working out these figures might seem daunting, so let me tell you a bit about the idea of cash flow modelling. Cash flow modelling is a great way to focus in on these questions around expenses, savings targets, and future plans. A cash flow model is a detailed picture of your assets, debt, income, and expenditure. We can then project this forward year by year using assumed rates of growth and income and inflation and interest rates to see where you can end up. So it's a little bit more sophisticated than you trying to tot it up on the, on the back of a fag packet or a post-it note in your cabin. We also can model a range of what if cash flow scenarios. So what if you move house? What if you change jobs? What if you start or grow a family? And this allows us to address many major concerns, including what you must do now to help achieve your financial objectives, how seemingly minor changes can dramatically change your financial future, how to avoid running out of money, how long will you be able to support your desired lifestyle in retirement. And you don't have to do this on your own. You can speak to an advisor. I'm happy to help, and we can help run through cash flow models for you. It's something that both Anna and Sarah said, is you're not on your own. You've got all of us here to help. So all you need to do is pick up the phone or fire over an email. So the key takeaway from this first point is that you should build up a cash buffer, think about your goals and aspirations, and then use cash flow models to help guide you to successfully achieving those. So point 2, future tax efficiency. So what can you do to minimize future tax liabilities while you are saving? Many yachties will qualify for the seafarer's earnings deduction, so are tax exempt whilst you're at sea. But it is naive not to think about how these assets will behave once you're back on land and in a taxable position once again. So it's really important to make sure that you're saving in a way that allows assets you have to remain out of the tax net once you return to land. For UK yachties, the use of ISAs and pensions are obvious ones. ISAs allow you to save £20,000 a year, free from capital gains and income tax. So imagine if you can pay £20,000 a year into your ISA for 5 years and it's invested. So you come back to shore in 5 years' time and you have a savings pot of £100,000 plus hopefully some growth. And that pot is not liable to any income tax if you want to start drawing an income from it, or capital gains tax if you wanted to sell the lot and buy a house. Had you not used that ISA wrapper, you would be liable for both of those taxes. The ISA is endorsed by HMRC, and there is no cost to using an ISA wrapper, and there's no you don't have to make a minimum or maximum amount of contributions. You're not constrained to making regular contributions. You can add them ad hoc. You're not tied into a certain number of years. It's completely flexible. It's just a wrapper around your investments, and you can add up to £20,000 a year as and when you wish each tax year. And then if you want to sell it, you sell it. And it really is as simple as that. And there's no cost. There's no additional cost to using an ISA wrapper than there is around a normal investment. So that is a really key one. And for those who are able to save more than this each year, there are other options that can be explored, such as offshore bonds. And for non-UK yachties, we can also help you set up offshore portfolios. Point 3, everyone's been waiting for it, pension. Now, please don't all switch off. I very much doubt that many of you have considered setting up a pension because it's not often on the forefront of your mind, particularly for those who are younger and starting out in their careers. For those of us that work on land, we're lucky because it's mandatory for our employers to pay into a pension for us. And we also have the opportunity to top that pension up each month if we wish. For some reason, this is not the case for everybody working at sea. And in my experience, the only pensions that I've seen set up for crew are on commercial ships. But a pension is really something everyone should think about. Essentially, the sooner you start paying into a pension, the more you will end up with on retirement. And for those of you who can see, I've got a slide here with some worked up examples. And again, if you can't see, go onto the portal later or whenever, and you'll have a look, flick through, and it's all very clear. So on this example, this is in fact a UK yachtie contributing into a pension pot, but each country will have their own arrangements. So as a UK resident, you can save up to £2,880 every year, even as a non-taxpayer whilst you're yachting. You can put that into your pension. From that initial investment made by you, your pension administrator or investment manager can apply to HMRC on your behalf and make a 20% tax reclaim of £720, topping up your contribution to £3,600 per year. So that is £720 of free money from HMRC, which never really happens. It's always the other way around. So this is another reason why you should grab it with both hands if you can. Now, if you were to invest £3,600 per year between the ages of 20 to 60, you could very easily end up with a retirement pot at 60 of £480,000 based on a low-risk investment portfolio, returning an average of 5% per annum, which is what our low-risk portfolios have achieved over the last 20 years. Of that sum, £28,800 is an accumulation of those tax reclaims from the government. So whilst it might seem that adding these very small amounts into a pension is pointless, it really, really does all add up down the line. From little acorns, mighty oaks grow, as they say. Now, reminding you of the benefits of starting a pension early, let's look at the impact on delaying those pension payments from 20 until you're 30. So if you're paying in 3,600, well, you're paying in 2,880 per year, getting your £720 free from the government to top it up, and you started at 20, the figure at 60 would be around 480,000. Delay till 30, that pot goes down to 256,000, and delay until 40, and your pot's going to be around £135,000. So that is a mega difference. And you know, this is your pot for retirement, so you're not probably going to be in a position where you can work, and you're relying on this for a regular income, probably. So let's face it, we can all afford to put in 2,880 into a pension each year whilst we're earning. So let's take the opportunity now to get going. Pensions are free from income tax and capital gains tax whilst they are invested. And of course, you can't touch them currently until you're 55. So these are long-term pots for your retirement, and which is quite good because they're out of temptation's way. It's not something you can dip into and spend. They're also really useful tools for inheritance tax planning because you can pass them on to other members of your family, say your spouse or your children, outside your estate, so free from IHT. Okay, so that's enough about pensions. Let's move on to my fourth and final point. Now, this point is a bit more detailed. It's about how to make the most of your savings. You've worked really hard to get your savings, so now they need to work hard for you. As explained, always keep a cash buffer in case of times of crisis. But to keep all your savings in cash could be seen as rather reckless caution as it's known. In other words, people often see saving in cash as risk-free and cautious, but it can be seen as reckless in that you're not only forgoing the potential for growth, but you are locking in a loss if you're staying in cash. Cash is not risk-free. Inflation is a very real risk. Now, for those of you who might not be entirely clear about what inflation actually means, I promise you it's very simple. It is the rate at which the general level of prices for goods and services is rising, thereby eroding the value of the cash that you hold. So let me say that again. Inflation is the rate at which the general level of prices for goods and services is rising. Now, for those of you who can see, I've got an everyday example here that I think makes it quite plain. And we're going to look at how the price of a cup of coffee has changed over the course of the years. This example is in dollars, but of course inflation applies in all currencies. Now, in 1970, your cup of coffee cost you 25 cents. 1980, 45 cents. 1990, 75 cents. And by the year 2000, it was around $1. 2010, $1.25. And by the time we've got to 2020, a coffee can cost you as much as $2.50. So this means that the $100 in your savings in the year 2000, when a coffee cost $1, could have bought you 100 coffees. But the rising price of coffee, i.e. inflation, means that the same $100 can now only buy you 40 coffees. So we can see how this impacts the savings in your bank on this next slide when we compare the growth of cash savings versus equity markets over the last 10 years. This is based on real data. Now, equity markets, to put in simple terms, is stocks and shares. So equity is money that you invest in a company by purchasing shares in that company in the stock market. That is an equity. So you should think of it as shares. £10,000 invested in your cash savings 10 years ago, this is based on real data, would now be worth £8,424 in real terms. This loss is because of inflation, which has averaged 2% annually over those 10 years. So your £10,000 from 2010 will no longer buy you the same number of coffees, tanks of fuel, and pints of beer, or Jaeger bombs, because they've all got more expensive. And if inflation is running at 2%, and the bank is paying you 0.5% interest, and right now you'd be lucky to even get that, you are effectively losing 1.5% every year. A scary thought. So that's why you've gone from 10,000 to £8,424 in real terms. The stock market, however, as represented by the FTSE All Share in this instance, over the same period has turned £10,000 into 21,354. Remember, cash was 8,424 after the same period. So how has it done this? Well, you're buying into the companies who are increasing their prices in line with inflation and other market factors. Thereby, you're helping retain the real value of your investment and hopefully growing it, as has been shown over the last 10 years. It's widely expected that longer term, post-COVID, inflation will start to increase beyond 2%, coupled with the fact that interest rates are at record lows. In the UK, for example, the bank base rate of interest is now at an almost unheard of 0.1%, and some euro and US dollar accounts are paying negative interest rates, i.e. you are paying the bank to hold your cash, which no one can much like doing. So if you're looking at negative interest rates or extremely low rates of interest, and inflation is running at well over 2 or 3%, the impact of inflation will be felt even more severely than it has been to date, shown in this graph. So to be clear, if the rate of interest paid on your cash does not keep pace with inflation, you are losing money in real terms. So what can you do? Well, you should consider investing. We have discussed the risk around saving in cash, so what about the risk of investing? People sometimes consider investing to be high risk, but it really needn't be. A good investment manager can tailor a portfolio for you to meet your objectives and appetite for risk by investing in quality, well-run companies and stocks. And I'll show you an example of that shortly. There are other benefits too. The first being diversification. Diversification is an important risk management strategy that mixes a variety of investments within a single portfolio. By holding a mix of distinct asset types, your investment manager can limit exposure to any single asset class or risk. Diversification strives to smooth out what is called unsystematic risk, i.e. the risk that is inherent in a specific company or industry. The benefits of diversification hold only if the securities in the portfolio are not perfectly correlated, that is, that they respond differently to the same market influences. So in other words, don't put all your eggs in one basket. If you're invested in only one asset class or one country or one currency, and that asset falls in value, then all your savings are going to fall in value too. So you must have a mix. You must have a mix to do that. And the reason to employ a professional investment manager is to try and get that balance right. You don't want to over diversify and be holding a massive spread, because then you won't benefit from the upside. So the idea is to cushion the downside falls, leaving you a bit of springboard to make the most of the upside when it comes and hopefully outperform on the upside. And that is as per this slide on the screen here, for those that can see, getting the right mix of geographic regions, countries, currencies, market sectors, different asset classes between cash, bonds, equities. So it is quite a science. So it is often worth speaking to an investment professional about it. Historically, portfolios constructed of different kinds of assets have yielded higher long-term returns and lowered the risk than that of individual holdings or securities. Property is often the investment go-to for yachties, and there is of course something to be said for bricks and mortar. However, I would caution against investing all your hard-earned savings in one asset class. Remember that we are usually overexposed to property anyway. If we're lucky to own our own house or flat, that usually represents the majority of our assets. So to then invest further in property does mean you are significantly focusing your risk in one area. Another benefit of investing is the income potential. By saving wisely throughout your career, your investment portfolio can be tailored to generate a targeted level of income. This might be to supplement your living expenses while setting up a business, or indeed might help you to afford to grow a family, move to part-time working, or even retire. And actually, I look after several yachties who have saved really wisely over the years and have investment portfolios that have grown and grown and grown. And they're now able to, these guys are typically around sort of late 30s, early 40s, and they've got these pots, and they're now able to drop down to part-time working, just doing a bit of relief work 3 or 4 months a year, and their portfolio can generate an income to supplement the rest of their lifestyle. So very nice too. And the great thing about investing is that you can change the mandate of your investment portfolio. So you can go from targeting capital growth really aggressively for, 5 or 6 years, then thinking, oh, you know, maybe year 6, 7, I might reduce the risk a bit because I don't want to suffer market wobbles and I want to start thinking about taking an income. And we can do that just by adjusting what you hold. And obviously with less flexible assets, that does become a bit harder. So I think flexibility is really important as we move through life and the different challenges that it brings. And thirdly, when thinking about investments, people often ask about timing. And there is a good old saying, which is, it's not market timing, it's time in the market. And that really means that you have to be in the market to gain the upside. So you're not only necessarily investing in assets for capital growth, you should have a mixture of income generating assets in there too, so that if there is, you know, a market wobble, such as we saw earlier this year to quite a degree, then you're not just relying on companies growing in capital terms, but you are taking that income too, and that means the income stocks are supporting the capital stocks. Now, equity markets fell decisively from January of this year when Wuhan went into lockdown, but they have stabilized during the summer months and beginning of autumn. Ironically, the American markets are at an all-time high. And you've no doubt seen that Apple, it's largely due to the makeup of their markets, which is very tech focused. For example, Apple, which is $1 trillion company, is larger, that single company is larger than our entire FTSE 100 in the UK. So that tech focus in the US has meant they've been at record highs in spite of coronavirus. So yeah, very interesting indeed. So is now a good time to invest some cash reserves into the market? Well, if you're a long-term investor with a minimum 3-year time horizon and you've got your cash reserves to cover contingencies, then yes, investing in cash that would otherwise be in the bank, producing next to zero returns or negative returns, once you think about inflation, makes good sense at current levels. Why? Because you are buying into today's market, but at 2016 prices. It has been noted that the financial markets are the only shop, in inverted commas, in which you hoist up a sign saying 33% off and everybody rushes for the exits. There are some great buying opportunities out there still, and the UK markets, for example, are still down 20% to get back to where they were in January. That's not to say that investment portfolios are, because that is the whole point of employing an investment manager, is that you are trying to outperform the market and cushion the downside, as I explained earlier. So there are some really great opportunities out there, and I would say that happily our investment portfolios are showing positives now, which is great stuff, outperforming the market, and particularly in the long term. And if anybody wants any detailed performance figures for the different risk scales over the years, we've got a 20-year track record which covers some real peaks and troughs in the market. So I can give you real data to show how markets and portfolios have performed during those times. So in terms of timing now, in the short term, markets may well take another tumble on bad news, but this gives us a great opportunity to invest more of the cash we hold as dry powder in our funds, or you might hold in your bank, in these uncertain times. With volatility comes opportunity. I think Sarah actually made that point in her introduction. But unless you believe that people are going to stop eating Ben & Jerry's or putting Marmite on their toast or cleaning their kitchens, why would you not add to a long-term holding like Unilever at 30% cheaper than you could last year? For those of you who can see my slides, I've just put up the H1 2020 results for Unilever, and you'll note how they've benefited from sales in 3 sectors in particular. Home and hygiene up 24%, skin cleansing up 27%, and in-home, so that's things like Ben & Jerry's, mayonnaise, Lipton tea, Marmite is up 17%. So you know there are real winners in this crisis, and for people that make Blue Cleaner, hand sanitizer, and ice cream, I think it's got to be a continuous long-term win for them. So finally, when looking at investments, I will just highlight the fact that it is really important that your investments should be liquid and that you should have control over them. And I will wrap up. This is just coming into the last few minutes now. So if an asset is liquid, it means that you can sell it easily, converting it to cash in a short amount of time. Cash is the most liquid asset. However, some investments are easily converted to cash, like shares, gilts, and bonds. As such, they too are referred to as liquid assets. Land, property, or buildings are considered the least liquid because it could take weeks or even months to sell them. And the same can be said for assets like wine or cars. Since these items take time to sell, and in order to release cash quickly, you might have to accept a price well below what you believe the asset to be worth. It is really important that your investments are liquid so that they can be flexible to support your needs. If you have a savings plan, make sure it is flexible and gives you control over how much you are adding and when. Try not to get trapped in a plan that has a fixed level of contributions that are required every month for a set number of years. You may find that you're not able to make the payments if you find yourself between boats or leave yachting, and that could leave you subject to nasty surrender fees and penalties. And I've seen, sadly, lots of people trapped in these things, and it's really nasty, and I would caution everyone to avoid those. So in conclusion, last slide coming right up, I just wanted to remind you of those 4 key points. Point 1, try and plan your exit as soon as you can, have that cash buffer in place. Point 2, tax efficiency, and that is beyond making the most of your seafarer's earnings deduction. You need to think about what those assets how they'll be taxed when you move back onto land. Point 3, pension. Start your pension as soon as possible. And 4, make the most of your savings and just be aware of the risks of holding cash, namely inflation and low interest rates. These are all things you can think about addressing now, whatever stage of your career you're at, and the sooner the better. And as I said at the beginning, I think transitioning onto land can be stressful and anxious, but if you have a strong, comfortable and well thought out financial plan, this will really help build flexibility and give you time to make the right choices for you. And you don't have to do it on your own, so do consider talking to an advisor who can help you. There is a really strong link actually between mental health and financial stability, and I believe Iswan, who are talking later today, have touched on that previously, so don't underestimate the importance of it. Now, we're not going to take questions on the call, I believe, but do get in touch with me via the Life After Yachting portal to arrange a one-to-one chat about your current situation. I'd be delighted to chat to any of you who have any questions, whatever stage of your career you're at. And I'm around all day and welcome any questions after the event too. And you can also get in touch with me via Instagram at Yacht Crew Investment, or my telephone number and email address are also on the portal. So do get in touch at any time. I'm always here and happy to speak. And I believe I'm being followed by Will from Bond Technology Management, who has a fascinating and inspiring story to tell. I've read a bit about Will. But thanks so much for listening, everybody. I'm trying to get you back off my PowerPoint now, but I'm not sure if I've succeeded. But yeah, thank you so much again to Titta and Sarah for having me. And good luck with the rest of your day. Sarah, I hope that's all gone okay for you.
Perfect. Thank you very much, Emma. I was taking notes myself, actually. There was... certainly, so I may be one of the people calling you, go, Emma, did I understand this correctly? So
well,
yeah,
please do.
Thank you. I will for sure. We'll get the screen share turned off so that we can just see you. Is that something that you can do as our host, Titta, or does Emma need to unshare her screen?
I think she needs to unshare her screen.
Oh, looks like it might be that's it, and then we just need the video back on for a final goodbye, and then we're good. So yes, thank you, Emma, for all of that. And for those of you listening on Super Yacht Radio that perhaps couldn't see the screens straight away, we will be providing the information in snippets following this event. So don't worry if you really wanted to see some of Emma's amazing graphics and things like that. We'll make sure that that sort of information is available to you. And just like Anna, who started our day with us, Emma is available through our online portal. So you just need to go on to lifeafteryachting.com if you haven't already, click the blue button and register, and then you can easily connect with all of our support network, our job providers, our Krakens from the Krakens Den, and arrange short meetings to see if you can get the support that you need, or even find out about some support that you didn't realize you needed, but now you know that you do. So yes, once again, thank you, Emma. As we've all said, the financial side of any move in life is really important. So having clarity and having somebody that you can trust is really important, and you for sure have shown those two qualities to me. So thank you very much. We really appreciate it. And also the day continues to work like clockwork, and I can see that Will is joining us. So we're doing really well.
Thank you for having me, and I'll leave you to it. Good luck for the rest of the day.
Thank you, Emma. Thank you.
Thank you. Talk to you soon. Thank you very much for a fantastic presentation.